I always tell every group before whom I speak, be careful about applauding for the speaker before you've heard him speak. You might regret that you've done it already. I was very fortunate to have done an interview with the Wall Street Journal earlier this week. I was on Fox Business earlier this week, and now you've invited me back for, I don't know, the 12th or 13th time, and I was calling my lovely bride this morning and said, can you believe these people in your wildest dreams would have me back this many times? And my wife said, wait a minute, we've been married 30 years. It's been 32 since you've been in my wildest dreams. So she brings me home and keeps me stable after a period of time. I always tell people that I'm a trader. And what I get up every morning at 1 o'clock and try to write 7, 8, or 9 pages of cogent and hopefully somewhat humorous commentary on what's going on in the capital markets. And I want you to know that I have my own money at risk every day. What I say in my newsletter is what I'm doing. And we'll talk about the things that I'm doing right now. Let's talk about, first of all, trade. I'm somewhat to the right of Genghis Khan politically. I'm a Republican and have been for all my life. And the President of the United States is an idiot. He's an absolute, abject, unadulterated idiot. He does not understand trade even slightly, and I want to make sure everybody understands that fact. The fact that he has tried to tell the American public that the Chinese will pay for their tariffs is without a doubt the greatest lie I've heard economically in the past 20 years. Let's think about what we do with China. It's very simple. We buy stuff from the Chinese and we give them paper in return. We buy stuff from the Chinese and we give them paper in return. It's a brilliant trade on our part. The fact that we run a trade deficit with China does not disturb me even slightly. In fact, and it's very abundantly clear, take a look at the last time the United States actually saw a decline in its imbalance of trade. This tends to be a group that you tend to be gold bugs. I understand that. And you tend to worry about the trade deficit. I understand that. And if I can do anything right now as to allay you of your fears, remember this. Since 1972, every year except for 2008, 2009, and 2010, the U.S. imbalance of trade got worse and worse and worse. And only in 2007, 8, 9, and 10 did the imbalance of trade get slightly less bad. I tell people I can resolve the United States imbalance of trade, and I can also resolve the United States budget deficit very quickly. How do I do that? Run the marginal tax bracket to 100%. Take every single penny that you make and send it to the government. What will happen? We will import nothing. We will run balance of trade surpluses for 3 or 4 or 5 or 6 months until we run ourselves into a terrible depression, which of course we shall. We'll balance the budget for about 3 months as tax revenues, as people pay so much more in taxes because the marginal tax bracket has gone to 100% before they can figure out how to get around it. For a short period of time, we will have resolved the imbalance of trade deficit and the budget deficit. However, do we really wish to do that sort of stupid thing? Do we really wish to go back and revisit the economic downturn that occurred in 2007, 8, and 9, which is the only way that we resolved the imbalance of trade and made it slow down somewhat because we were simply importing fewer and fewer goods? Since 1972, when I first got into the business, they told me the same things every single year. We cannot continue to run budget deficits as large as we have, and we have to do something to resolve the imbalance of trade deficit or the economy will collapse. They told me that in 72. In 1976, they told me that if we continue to run budget deficits as large as we are, and if we continue to run trade deficits as large as we are, the country will collapse and we cannot stand it. They told me in 1982 that if we continue to run budget deficits as large as they are, and trade deficits as large as they are, the economy will collapse. They told me in 1986. They told me in 1992. They told me in 1997. They told me at the turn of the century that if we continue to run trade deficits as large as we are and budget deficits as large as we are, the economy will collapse. They told me in 2005 that this has to change. They told me in 2010 that this has to change. They told me in 2015 that this has to change, that we cannot continue to run the budget deficits that we run and the trade deficits that we run, or the economy will collapse. It was garbage for the last 40 years. It is garbage still today. There shall come a time, sometime in the future, rest assured that it will happen, that we cannot run budget deficits and trade deficits as large as we do. At some point in the future, that shall cause a problem. But that time is not now. It has not been for the past 50 years. It is not presently, and it's not likely to be for the next 20 years or 30 years or 40 years, or as long as my children are alive. Two, as long as the United States remains the reserve currency of the world, we have the ability to fund our deficits ad infinitum. And who defines reserve currency status? It is abundantly clear. The country with the largest military, the most powerful military, always and everywhere has been the reserve currency of the world. Go back into the centuries past when Portugal was the dominant military, the dominant naval power in the world, and for a short span of time, the Portuguese currency was the world's reserve currency in what was then the civilized world of Europe. Spain surpassed them because Spanish Navy defeated the Portuguese Navy, and Spain became the dominant military power in the world. When they lost to Britain in the Spanish Armada, which was stupidly defeated, Spain stupidly defeated, sending their warships into the middle of a storm, and the British simply outmaneuvered them. But for the next 400 years, England was undoubtedly the powerful nation of the world. Its navy was everywhere. There was something to be said with the sun never sets on the British Empire. And for that period of time, until the Suez Canal War in 1956, after World War II, we became the dominant military power. And since then, we have been, without equivocation, the dominant military power in the world. Until that changes. And that is not about to change. Not in my lifetime, not in your lifetime, and not in the lifetime of your children and grandchildren. Unless something truly stupid happens, unless we decide to elect Miss Harris or somebody like that, which is possible. But until that happens, we shall remain as the world's reserve currency. And as long as we do, we have the ability to fund our debt ad infinitum. Don't ever forget that fact. Let's talk about interest rates for a moment. We live in a most amazing world, don't we? The fact that we now have negative interest rates, it depends on which day you take the number, whether it's 14, 15, 16, or $17 trillion of negative interest rates amongst sovereign nations. We live in the most amazing period of time in the history of economics. We will look back on this period of negative interest rates 100 years from now and say, what the hell were we thinking? But it will change. But right now, the trend in the United States, the trend in Europe, the trend in Japan, the trend in China, the trend everywhere in the world, as we've heard so far this morning, is interest rates to go from the lower left from the upper left to the lower right. And that's not going to continue or not going to end anytime soon. It's going to inure to the benefit of the US dollar. Has to. Cannot be otherwise. If you consider the fact that if you were some kind of oligarch sitting in an island in the middle of the Pacific Ocean, and you had several billions of dollars to invest on a daily basis, and Germany comes to you and says, for the next 10 years, I'd like you to pay me for your money. And the United States comes to you and says, for the next 10 years, I will pay you 150 basis points for your money. Where in God's name are you going to put your money? It's really quite that simple. And until negative interest rates disappear, and right now there's no probability within the next year or two or three or even longer for negative interest rates to disappear, because the banks in Europe are required by the ECB to hold X amount of their portfolio in German, in Italian, in French, in Belgian, in Luxembourgese bonds. As long as that continues, interest rates are going to remain negative. As long as that continues, the US dollar has no choice but to go from the lower left to the upper right on the charts. Has to. Cannot be otherwise. Again, if you're an oligarch sitting in the middle of the Pacific and people are hitting you every day for your investment dollars, and Germany says, we want your $2 billion and we want you to pay us for that, or America says, we want your $2 billion and we will pay you for that, and America remains the reserve currency, and America remains the dominant military power, how can it be otherwise? How can anything other than a strong dollar continue? Let's talk about, anybody got some water? Let's talk about gold. Okay, let's talk about gold. People like to talk about gold. And I've been bullish of gold for the last 5 years. I want to make sure that everybody understands I am not a gold bug. I do not believe that gold is the be-all and end-all. There are times when one should be long of gold. Oh, thank you, Kathleen. There are times when one should be long of gold. There are times when one should be short of gold. There are times when one should have no opinion upon gold. But for the past several years, I've been bullish of gold, and right now I continue to be. That's my largest position in my own account. And I must tell you that today, given the weakness in the gold market, I'm a little more antsy than I have been for quite some period of time. In fact, I gave an order to Chip in my office to sell a little bit of my gold this morning, because that's what good traders do. When markets move against you, you reduce your exposure. It's what good traders have to do. Now, if I think that the dollar is going to continue to get stronger relative to the euro, if I think that the dollar is going to get stronger relative to the British pound, if I think that the dollar is going to get stronger relative to the Chinese renminbi, it makes sense for me to want to own a commodity such as gold in a currency other than the US dollar. I want to own things in currencies that I think are going to depreciate in value. And I've been far more bullish of gold in euro dollar terms than I have ever been in terms of gold in US dollar terms. Take a look at the course of the euro over the course of the past 18 months. It has consistently, from the upper left to the lower right, it has consistently been falling. It's gone from, call it 120 to the euro, down to 108 and something this morning. It's consistently been falling on a very obvious path. Gold, on the other hand, in dollar terms, has been going from the lower left to the upper right. If you own gold in euro terms, you have increased the return on your investment by a multiple. And what's important is, because intraday and interday, on balance from 1 hour to the next, from one day to the next, maybe you'll see gold and euro move together, but on balance, they tend to balance one another off. And if you can own a gold, for example, in euro terms, you mitigate the intraday and interday noise. And that is, after all, the nirvana of trading, is to have a bigger return on a lesser volatility. No question, henceforth, when you step up and wish to buy gold, try to think in terms of owning it in euro terms. Now, many of you are saying, well, if I do that, I'm exposed to a dollar exposure. I have to revert my euros back to dollars. No, you don't. No, you don't. The trade is very easy. Buy GLD, which gets you long gold and short dollars, because when you buy gold, when you buy soybeans, when you buy corn, when you buy cotton, what you have effectively said is, I'm buying that commodity and I'm shorting US dollars. That's really what you're doing. So if you buy gold in dollar terms, you're long gold, you're short dollars, you have an exposure. If you then go and buy dollars and sell euros, you're now balanced. And you've mitigated intraday risk. Now, I had an ETF, and it had listed on the New York Stock Exchange, which I thought made eminent sense. We brought it out about 5 years ago. It failed miserably. It never got more than $50 million of worth put into it, because I guess it was too complicated for the average American investor. The company that I put it through, or that brought it and had it in my name, closed it the day that gold in euros made its low. Absolutely on the day, almost to the hour. No question, therefore, that the trade was the best trade that you could have possibly put on. So I want to be bullish of gold. I continue to think that inflationary pressures are likely to become incumbent around the world, because all monetary authorities have no choice but to remain expansionary. If you look at the economy in Europe, it's no longer moving from the lower left to the upper right. It's at best moving sideways, and in most instances, it's moving down. The monetary authorities have no choice but to remain expansionary. They also need to remain expansionary as far as their balance sheets are concerned. They have to spend money on infrastructure. They have no choice. But because infrastructure spending is basically impossible in Germany for various laws, the only choice that the monetary authorities have, the only choice that the fiscal authorities have, the only choice that the political authorities have, is to force the monetary authorities to become more and more expansionary. They have no choice. That's what they're doing. They shall continue to do so. Buy gold in euro terms. It's going to be the best trade you put on in a long period of time. And it will let you sleep overnight when news breaks out and suddenly you see gold falling $15 and the euro weakens by 2% or 0.5%. At least it mitigates the risk. Let's talk about oil, which I find fascinating. Stephen told you that the United States is now, for the first time in the last 40 years, self-sufficient in energy. Most people in our business know that. The vast American public has no idea that this is true. And to put it in simple terms, the advent of technology, the better ability to drill, the better ability to look into the ground. As I've told people, We used to think that crude oil, that the facilities in the ground looked like your fist. We thought they were finite. And we found out that they really looked like your hand with its fingers extended. And we used to have maybe a 50% hit rate when we sent our soda straw down into the ground with the geologies and the technology that we had. And our hit rate until about 10 years ago was about 50%. Half the time the well came up dry, half the time you hit. And if you were lucky enough to hit the very top of the fist, that's when you got a gusher. But we found out that instead of looking like your fist, they look like your fingers. And the problem was, a lot of that crude oil lived out in the fingers. And trying to find the end of the finger was almost impossible. We could see it with seismic technologies. We have better views underground than we ever did before, and our hit rates are now at 95%. But the real secret is not fracking. The real secret is now we send one soda straw down in the ground and we bend it. Now we send horizontal drilling pipelines 2 and 3 and 4 miles away from the center shaft. We can send 5, 6, 7 different pipelines off the original well that we drilled. That's the big change, that and fracking. Now, it's interesting. You want to do something funny? Fracking obviously has changed the world. But take a look at where fracking has occurred in the United States. Obviously, it's occurred out in the Permian Basin. We thought the Permian had run dry until we found out that rather than this is how the structures look. Now we send the soda straws down, bend it. We're pulling crude oil out of the fingers that were preposterously uneconomic only a mere 5 and 10 years ago. But some states ban fracking. Some states ban drilling. Go to Google and Google the map of oil rigs on the border of Pennsylvania and New York. New York has banned fracking and drilling. Pennsylvania embraces fracking and drilling. There are hundreds of wells on the border of Pennsylvania and New York. Pennsylvania drillers will say that we're not taking any of the crude oil out of New York. Bullshit. Of course they are, and they will continue to do so. Fracking has changed the world. Drilling has changed the world. Technology has changed the world. We need to understand that. We're going to continue to be an even greater supplier of crude oil. We now produce, it depends on which day of the week it is, whether Saudi Arabia is above us by 100,000 barrels or whether we're above Saudi Arabia by 100,000 barrels. But we've gone from 4 million barrels of production a mere decade ago to 12.5 million barrels of production daily now. And in a couple more years, we'll be at 15 million barrels of production of crude oil here in the United States. It's an astonishing circumstance. Stephen brought up the concept of backwardation and contango, and I want to talk a few minutes about that because it will help you become a better crude oil trader. Watch as we call it, watch the term structure of the futures markets. In great bull markets, whether it's in cotton, whether it's in soybeans, whether it's in corn, whether it's in livestock, whether it's in the bond market, or more importantly, when it's in crude oil, the manner in which the term structure is situated tells you the direction of trade. In great bull markets, markets go to backwardations. The front months are above the second, above the third, above the fourth, above the fifth, above the sixth, above the seventh. In great bull markets, the market becomes backwardated, where the front month is above the next one back. That's telling you what the market is saying is, we are not going to pay you to go into storage. We need you, whatever that commodity is. Crude oil, we need you. Corn, we need you. Soybeans, we need you. When the market is oversupplied, it goes into contango, where the front months are below the back months, and therefore the market is saying to that commodity, we don't need you, and we'll pay you to go into storage. So the movement from backwardation to contango, or from the movement from contango to backwardation, is a very important journey. It's a very important signal as to how a market's going to change. Stephen told you that right after the hours after the recent supply upon Abqaiq and Qusay oil field, that we had a massive change in the 5 minutes? Really? You are strict. Wow. In moments, in the day after that attack occurred, the backwardation widened dramatically. And within hours, the backwardation began to narrow. That's not how a bull market should respond. That's not how a bull effect should have. That's not what a bull market should do. A bull market, we should have seen that backwardation widen, 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 and widen some more. And quite honestly, I thought it would. I thought the damage that was done that had been wrought upon the Abcake oil refinery was so serious that it was going to take months, if not a year, to bring new crude oil. But the market sent a signal almost within an hour that it was not as serious. And it took me 2 days to figure it out. It took me 2 days to figure it out. But I figured it out because the change in the term structure was telling me something. If you get nothing else from me today, learn how to watch the term structures, not just in crude oil. If you want to get bullish on the grain markets, watch soybean meal. Until the soybean meal market starts to invert, until it becomes backwardated, there's no reason to rush out and be bullish of the grain market. The term structures will tell you where informed, intelligent, wise money is finding its way. And if you get nothing else from me today, learn that about how to learn to watch what goes on in the futures. Watch the changes from backwardation to contango. When we hit $125 a barrel back several years ago, every day in the run-up to $125 a barrel, whether we had a down day or an up day, the front month in futures would widen against the second, the third, fourth, and fifth. Every single day, even on down days, the backwardation widened. And within about a week of the top, I started writing about the fact that, this is interesting. Here we are at $125 a barrel, and suddenly the front month is not gaining on the back month any longer. It told me that informed money, that sophisticated money, that wizened money was leaving the market. At the bottom, when we got down to $45 a barrel, in a great bear market, in a real bear market in crude, in a real bear market in soybeans, in a real bear market in cotton, the front month should lose every day to the back months. It should happen every single time. And we got down to $45 a barrel. All of a sudden, there were days when the market would fall and the front month gained upon the back months. To me, that was telling me that wise, sophisticated, intelligent money was coming back into the crude oil market. Watch the term structure. If there's anything that will teach you more about any of the markets that you watch it. Let's talk about stocks for just a few minutes, and then we'll get done here. It's a bull market. The greatest book on trading is Reminiscences of a Stock Operator. If you have not gotten a copy of Reminiscences of a Stock Operator, rush out this afternoon and get a copy. It was written, I think, in 1903 about one of the great stock market speculators of all time. But there's a conversation that is in there when he, as a young man, had been bullish on stocks and he started to take profits. And a wizened old trader, Old Turkey was his name, when Jesse Livermore asked Old Turkey what he thought about the stock market, Old Turkey said this: well, after all, it is a bull market. I try to pick tops all the time, and every time I do, it's wrong. It is a bull market. Write this down. It will continue until it stops. That's 50 years of wisdom condensed into 1 or 2 minutes. It will continue until it stops. I am stunned by the levels to which stock prices have gotten. I will be even more stunned 6 months from now. I'll be more stunned a year from now. I'll be more stunned a year and a half from now. It's still a bull market. Buy anything. It will probably do you a good, and it certainly has done me better than any time I've tried to pick a top. Finally, I'll tell you some of my rules of trading. This is the most important rule that anybody will ever tell you and teach you is this. Write this down. Do more of that which is working, and try to do less of that which is not. Do more of that which is working, and try to do less of that which is not. The old rule is hang on to your winners and cut your losses. I say it's simpler than that. Do more of that which is working, and less of that which is not. Guys, if taking flowers to your girlfriend or your wife gets you lucky more often, take her flowers on a more consistent basis. It works in life. It works in trading. It works in investing. This is not a difficult business. This is really a very simple business. And as I stand back, as I get to be almost 70 years old, as I've been at this for 50 years now, I realize that the simpler I make it, the less convoluted I make it, the farther back I stand away from the markets, the better that I can look at a chart and say, is that moving from the lower left to the upper right? I should buy that. Is that moving from the upper left to the lower right? I probably should try to sell that. And as I do that, when I do that, I succeed. When I don't do that, I fail. That's my story. I'm sticking with it. As my old friend Paul Tudor Jones says, trading's like falling in love. Put your arms around that idea and you hold her tight. But if she shows you the first sign of disrespect, throw her overboard and disavow any association whatsoever. Thank you for your time, and thanks for having me back.